definitely going to get the ops saying that you're not a financial advisor. You can't go around telling people, giving people advice, telling people that they shouldn't invest in property and that they should do this and investing in crypto instead of property. Are you crazy? That's insane. It is insane, but what returns have Bitcoin done in comparison to your house over the last 10 years? He went there. He really went there. I did really go there. But anyway, let's not bust shots. Let's do the disclaimer first. Ninja, do you want to do the disclaimer first, please?
Yes, sir. Yes, sir. Let's get it. Okay, what's good, people? It is currently 6 minutes past 8 p.m. UK time. Monday, the 10th of July, 2023. Welcome to another amazing episode of The Game, which is a weekly webinar where we cover everything and anything from stocks, crypto, live technical analysis, looking at macro, micro trends, breaking down reports, even interviewing founders. However, it must be noted before we get started that we're definitely not financial advisors, so let's run over the quick disclaimer. So very quickly, all content is for education, information, and entertainment purposes only, and it should not be considered as investment advice or a recommendation to buy, sell, hold any assets, nor place any trades. Please always do your what, guys?
Research.
Yes, sir. Our content is intended and should only be used for informational use only. It is very important to do your own analysis before making any investments, which should be based on your own individual circumstances. You should always take independent professional advice from a professional advisor. Alternatively, independently research and verify all and any information you might find in our show. You may wish to rely upon whether you wish to make an investment decision or otherwise. All investments come with what, guys?
Risks.
Therefore, you should always do your own what, guys?
Research.
We're not financial advisors and do not intend to be perceived or received as financial advisors. See that high-pitched voice thing? That's not what financial advisors do. However, we're working in collaboration with several accredited advisors. If you're unable to mitigate your risk, please contact us immediately so we can refer you to an accredited financial advisor. How do you get in touch? You can email us at hello@blockchainsensei.com. You can tweet us at blockchainsen, and or you can DM us on Instagram at blockchain.sensei. Now, to join this free weekly webinar, what you do is you click in the bio of the blockchain.sensei Instagram or the bio of the blockchain. Actually, no, not this bio because this takes you to the website. Anyway, we need to get to this link tree. This magic link here, the Game and NFT Friday Zoom link. This is how you join the Zoom. Alternatively, catch replays at youtube.com/blockchain sensei. Like, comment, subscribe, etc. Now, I'm super proud to announce that Cairo Sean, are you in the room?
I am, yes.
Okay, so there was a cheating, technically speaking, featuring some commentary from Cairo Sean. Cairo Sean, aren't you the creative director of Shuriken Sounds and a producer? Since when and what do you know about technical analysis, sir?
Just minimal amounts.
What this proves, guys, is that we are all multidimensional beings. When in the world would you expect Cairo Sean to be talking to Mr. Harding on a Sunday evening about charts? If Cairo can do it, why can't other producers do it? Cairo produces better than most you producers. And now we can start now we can trade and invest and do technical analysis with Mr. Harding. We're limitless beings, guys. So yeah, tune into this free weekly webinar. Yeah. I kind of just sent for producers. So how are you gonna let a man produce better beats than you, know more about Web3, and is now doing technical analysis?
Yo,
come on, the levels are being set.
The levels are being set.
With a little evil laugh as well.
Maza. Okay, so today is unfortunately an episode that's going to make a lot of people very uncomfortable. It's going to make a lot of people have regrets. It's going to make a lot of people reassess themselves, their situation, their family situation. This is, in fact, an episode that we do once a year. We do this episode. We've done this episode once a year for the last 3 years. we've done this episode as its own segmented episode outside of the game. Now, what we're going to teach in this episode, we normally go into more depth in paid lessons. So the game we're about to give you for free, I'm going to tell you right now, all the courses we've researched on crypto, don't talk about this. All the courses we've researched on stocks, don't talk about this. All the courses we've researched on property, don't talk about this. All the courses we've seen on investing in gold, don't talk about this. But we talk about this because it's not financial literacy if you're not comparing all the asset classes, then you're biased. If you're not looking at the long-term gains of all the asset classes, how do you know that your long-term investing is the right thing to do? It doesn't make any sense. It doesn't make any sense. People are getting into long-term investing going, yeah, you know what? Crypto is my thing for long-term investing. But have you compared it to property? Nope. Have you compared it? Have you compared your stocks to property? Most people actually haven't. So big shout out to the Bit Blonde for joining us. What's goody? What's goody? What's goody? Thank you for joining us. Thank you for joining us. You know what, Bit Blonde, I'm gonna get you to say some bits when we get to the investing in crypto versus investing in property bit, because I know you're a massive Bitcoin fan. So yeah, we'll come to that very, very, very shortly. So where are we now? So yeah, I just wanted to drop that disclaimer. This episode isn't meant to be personal. Don't take anything we're saying in this episode personally, but do share it with friends and with family, because it's important that people just look at the facts and look at reality rather than just going about life blind and hoping. A lot of people are living on hopium and just going, yeah, this is what you invest in because that's what everyone else is invested in. Yeah, this is the way that you escape. This is the way that you do things because that's what all of society does, because all of society is told to get a job, get a car, get a house, get a little bit of gold. Nice. All right, cool. What we're going to do is we're going to take the numbers from the gold, take the numbers from the property, the numbers from the stocks, the numbers from the crypto, and compare them over a 20-year period and see what outcome you prefer. So the thing we're definitely going to need today is the compound calculator. So Ninja, if you pull that out, we're not going to need it right now, but if you have it ready, locked and loaded.
Well, that's my favorite. That's my favorite thing.
It should be everybody's favorite thing, because that lets you know if you're on track to achieve the goals that you want to achieve. I'm going to say most people's goals financially from investing is that after 20 years, they want to be a millionaire. They want to have £1 million of assets. Is that fair and safe to say? After 20 years, people want to have £1 million of assets. That's pretty fair to say, right? So that means if you're 20 and you start investing now, by the time you're 40, you want to have £1 million of assets. If you're, say, 40 and in 20 years' time, you want to have £1 million of assets. That's most people's aim. That's what I would believe. So let's break this down. The first thing most people do with their money, if they're not investing or they class it as investing, is people do this thing called saving because they class saving as investing. The first financial literacy mistake that there is in society is that saving and investing are the same thing. People think, oh, yeah, you just got to save your money, man. You got to save your money. Make sure you're saving your money. That is one thing I've definitely seen in my family, definitely seen in the Black community. Make sure you're saving your money, you know. Make sure you got some savings. You always need some savings. So I don't disagree with that. I completely agree with that. But when we're talking about these savings, what kind of returns do we think we're getting on these savings? Because over the last 10 years, 5-10 years, you've been getting, if you're lucky, from saving your money in the bank, a 1%, 2%, if that. if you're lucky. So let's go to the compound calculator. Ninja, pull it up, wheel up the thing. And let's see what returns you would have got on your money from 20 years of saving. And what would we say is an amount the average person in the United Kingdom can save as an investment? A PlayStation is about 500, and everybody in the UK says that they're poor and that they're from the ends, but they're having a £500 PlayStation and a £500 TV. So I'm sick and tired of people saying, I'm from the ends, I've got to trap. Shut up, man. Stop lying, bro. If you got a PlayStation, you don't need to trap. Shut up. If you got 3 pairs of Nike trainers, or if you got some Yeezys, you're lying. You're not broke.
Balenciagas,
You're just moving mad with your financial.
Priorities are left. They're gone out the window.
Because people are saying that they're struggling and they had to do this because they had to save their mom and get their mom out the ends and whatever. But bruv, you got £400 trainers and you got a big £1,000 TV, but got no assets. Maybe the trainers might count as an asset because you can flip them. Well, come on, guys. It's not as bad as we deep it out to be. Society is making us think that we're trapped. But we're not trapped because we've got all the tools that we need in front of us and we're going to go through them. So I'm going to say £1,000. Do we all agree that the average person in the UK, no matter how much they're struggling, no matter, even if you're on £8 an hour, over 3-4 years can save up £1,000?
If you're financially literate, yeah.
Now, even if you're financially illiterate, people can save £1,000.
Yeah, absolutely. Over 3-4 years.
Yeah,
Come on.
over 3-4 years.
on,
Yeah.
Yeah, man.
Yeah. So let's put initial investment £1,000. Yeah. Okay. Cool. So the average saving account was given like 0.5%, but we're going to be really generous. I'm going to say it was 1.5. So let's call it 1.5. You're getting on your money over 20 years. Let's see what you get back. Yeah. Calculate that. There we go. You've earned a total of £309
Mad.
even over 20 years. Absolutely incredible. So that's over 20 years. You've earned 2 holidays, 2 Ibiza.
Oh, man.
Well done. Congratulations. Now, the thing is, that's not calculating for inflation. So if inflation is going up like it was the last couple of years, 7%, 10%, that means that your money's actually gone backwards. So people think that saving, the first financial literacy rule, people think that saving is risk-free. They think that saving cash in their bank account is risk-free. Guess what? It's the actual only guaranteed risk because of inflation. You are guaranteed to lose money.
It's the worst thing you can do.
Worst thing you can do.
And the reason why is because the banks print your money.
Yeah.
You know, they multiply your money.
So if you go to the Instagram page, there's actually an image that I posted that shows, go to this one here, that one with the graph going upside down to the left. There we go. This is how much the average person loses in savings to inflation. So you can see the average person's losing, on average, about £500 to £600 a year to inflation, which is just pain for no reason. And last year, the average person lost £3,000 to inflation for no reason. And that's inflation. Don't even get me started on shrinkflation. You know what? Let me just drop the little shrinkflation bar. So shrinkflation is where, has anyone noticed that your packets of crisps are getting smaller? That when you go and buy your cornflakes, there's not as much cornflakes in the box. Anyone notice that the clothes aren't lasting as long? What used to last for 2 years only lasts for like 6 months now. Yep. That's shrinkflation. So as well as your money being worth less, the companies reduce the quality of their products or reduce the amount in the packets. So you're just getting stung. You're getting murked. So what do you need to do? Let's go to option 2. and we're going to talk about property because property is the holy grail for most people. So this image here, before I move on, is the Bank of England base rate, and we can see in the purple line it goes up, and it's gone up over the last year, and we can see interest rates have gone up for your mortgage, but the rates that you get in from your bank account doesn't seem to be going up as fast. It's interesting, that, isn't it? Not that.
What coincidence?
What a coincidence, man. That's crazy. So let's go on to the next asset, which is property. Let's see if there's another image. Oh, there we go. So the highest one that we got from highest interest rate that we can get is Vanquish Bank, 5.9%. So let's go back to the compound calculator and let's go with 5.9%. Remember, this is all based off a one-time investment. This is even based off compound investing or dollar cost averaging. 5.9, and do 20 years. Let's be generous. That little £1,000 one time. There you go. Well done. You doubled your money over 20 years.
Tripled.
Well done. Well done. Tripled your money. Sick. So you can see that society, most people will be gassed by that. Be like, yeah, that's good, man. You tripled your money. Yeah, man, I tripled my money, put my money in the bank account. Bank has got a little percent, triple my money, 20 years. I'm very happy with that. But let's just ask ourselves.
Meanwhile, that PlayStation he got 20 years ago is now worth $5,000.
Exactly. Them Jordan ones that he copped 20 years ago are now worth a house.
That way.
You know what I mean? But talking of houses, let's go and look at property. So, does anyone know what the average? So obviously, property does its ups, it does its downs, it does its whatever it's doing. Now, the thing about property that nobody ever talks about is the same thing as cash. There is a big giant risk that comes with it. Everyone is taught in society, financial literacy wise, the safest place you can put your money is in property. It's the safest place for you. Make sure you get a house. Make sure you work really hard and get a house. But what are the risks when it comes to property? Does anyone know what some of the risks are?
Well, they say more doors, more problems. It's never more doors, less problems. Exactly. Because it's just more shit that can get fucked up. Exactly. There can be a little mouse. There can be a little electricity. There can be noisy neighbors. You can't control the neighbors. What are you going to do if you get a banging property, but then you got banging neighbors that just bang? If you know what I mean. Well, that's into it. But you can't control those kind of factors.
Exactly. Now, versus your money just being in the bank, right? Your money just being in the bank, you ain't got no problems. You ain't got to deal with nobody, no nothing, no. There is no monthly maintenance fee that you got to do. There's nothing you got to do. You just put the money in, done. Now, with a property, what do you have to deal with? You got to deal with tenants if you're renting it out, if you're even doing that. But if you're not doing that and you're living in it, boy, you got bills, maintenance bills, council tax. You got to you've got to actually cut the back garden. They don't even tell you how much money you've got to spend on cutting the grass and cleaning the windows. I dare you to have a house for 20 years and not clean the windows for 20 years.
Yeah, that's a mad thing. Crime.
Imagine not cutting the grass in your front garden or your back garden for 20 years.
Imagine renovation as well, like renovation. You got to do a renovation.
Exactly. You telling me you can have the same central heating for 20 years? You can have the same water pipes for 20 years? Nah. So this is the risk that they don't tell you comes with the property. That's the first risk. Okay, what's the next risk? And it's hurting everyone right now. Is the interest rates. Because the UK doesn't have fixed interest rates. We have flexible interest rates for some unknown reason. In America, you guys are blessed. You get your interest rate the one time, boom, that's it. Simple. Here in the UK, boy, This interest rate is moving. Now, again, what people don't realize because they're not taught to do the maths is a lot of the time, if you're getting a house that's 250 grand, right? A lot of the time you're paying over at least an extra 100 grand just on the interest. Just on the interest. Now, when we start looking at some of these other assets, what 100 grand could do in those asset classes is terrifying. And we're not even, you know what? We will, because we've never done it in this before. But at the end, I want to see what would have happened if you put 100 grand that you would have been paying in interest into Bitcoin over the last 10 years. I just want to do the calculation. I just want to see it. And then we'll do it. We'll do a light one. We'll do it. What if it was that extra 100 grand you're paying on interest on the property was in Apple stock, because that's accessible. And then we'll do an Nvidia. And we'll just sip that tea like calm.
Pet lads.
Okay, so interest is the big risk when it comes to property. The average person in the UK right now, because the interest rate has gone from what have I got the note as here, 2.2% to 5.5%, the average person is now paying an extra £300 a month. When you bought your mortgage, when you first got your house, did most people calculate an extra £300 a month? Nope. So let's just take this and say that they didn't have the mortgage and they were just putting an extra £300 a month into the basic cash savings. So Ninja, let's go and do that. Let's go and have a look. Because this might actually be a bit wild.
Shout out billions.
Shout out billions.
Trust me,
So
serious.
initial investment is 1,000. Yeah. 5.9% yearly for 20 years. Now, let's not even do 5.9. Let's do 2. 2% yearly. Yeah. And then contributions, deposits, we're going to do £300 a month. Yeah, there we go. And then calculate. So this is if you didn't buy property, you just put cash in. There we go. 89 grand after 20 years. From just that 1 grand that you put in initially, you've earned an additional £16,000. That's just on cash. Yeah? Okay, cool. So let's now say, yeah, is everyone understanding where we've gone with the property thing? Now let's look at the final risk with property. Final risk, yeah? If you need the money out of your property that you've just been investing into that property for the last 10, 15 years of your 30-year mortgage, can you get it out quickly?
No.
Nope. There is people right now that I know in my network that have had to wait a year to try and sell their property, couldn't sell it, and have ended up on the new interest rate. Does that happen when you have your money in cash? Nope. Does that happen when you have your money in stocks? Nope. Does that happen when you have your money in crypto? Nope. Does that happen when you have your money in commodities? Nope. So it's a big risk that nobody ever talks about. Ever. And remember, I'm not going to say the good things on all of these. I'm going to slate the bad things on all of these asset classes, on all of them. So that's that. I could keep going in on property, but I'm not going to. So let's go to the next one. Let's go to stocks. Oh, actually, wait. I forgot to do the average. What do people think the actual average interest rate is on property from 1970s to now? How much do you think the average property has gone up by per year?
2
Type in
or
chat.
Feel like 5%.
5%.
Mm.
Okay,
Actually, 6 or 7.
6 or 7.
Yeah, it
Oh
probably
wait,
could be 7.
no, interest rates. I'd actually go lower.
No,
6.
not interest rates. How much do you think that your property is going up in value by? per year?
Oh, yeah.
It's yeah,
Say
I'd
5 to
stick with
7%.
I'll stick with 6 to 7.
5 to 6 to 7. Okay, cool. Well, the actual number is going to surprise you. It's actually 2.75%.
Damn.
So you actually, technically, when you look at the stats and the numbers, are better off having your money in cash in a savings account than in property. That's if you don't know what you're doing. If you know what you're doing, and you know how to buy the properties, and you know how to flip them, and you know how to do whatever and whatever, and you know how to rent it out and all of this stuff, calm, then property is for you. But if you don't know anything about property and you're just going, yeah, I need to get my money up, you're actually statistically, numbers, facts based, better off just having it in cash. Unfortunately, it's a bit peak, but at least with the property, you end up with a roof over your head and you end up with an actual asset that you own. But then it gets even more peak because the other risk that they didn't tell you about is inheritance tax. They didn't tell you about that one, did they? So that even when you
missed that one out, they forgot to
tell you that when you're getting your mortgage, isn't it? Just like they forgot to tell you about the maintenance costs of having to clean your windows and whatever, and interest rates and all of this. They also forgot to tell you that, you know, the inheritance tax in the UK is definitely more than 20%. Ninja, do we want to Google what the inheritance tax is in the UK? Because people I don't think people realize.
40%.
There is a threshold.
There is a threshold, but still.
Just say 42%.
40%. 40.
What the? Nah.
That's almost half.
So wait. Let's just get this straight. Let's just deep the maths of this, right? You get a house that's valued at 250 grand or whatever it is, yeah? You end up paying an extra 100 grand in interest on this property, plus your maintenance and all the money that's going to it and whatever. And then on top of that, when it comes to your next of kin inheriting it, they get taxed 40%.
Yeah, this is how the system catches people.
Differently.
That is crazy.
Like, yo.
Now that's a violation. Fam.
Am I
Like,
lying,
bro.
or am I just putting out facts and numbers? We are just putting out facts and numbers here, but no.
Obviously,
Like-
everyone's got to do their own research and confirm if what we're saying is absolute cap or absolute facts. We're not even determining facts. We're just showing you information that we found, which may or may not be true.
Every situation is individual.
Yeah. Every situation is different. So in this example here, it's saying anything over the 325,000 that you make.
But in London, is an average house less or more?
Yeah, in London, you're over that.
Yeah, exactly. So everyone is getting
Sorry.
checked. That is ridiculous.
Wow.
What is this?
Wow.
A yearly tax, monthly tax, or a one-time?
Oh, it's
tax?
just the moment you try to sell, when someone's died and they try to pass it on to the next of kin, anything over 325 grand is taxed at 40%.
Joke, man.
Allow it, bro. Like,
But it depends. There's a number of factors that come into play because basically you've got both parents have what's called a nil rate band. You can combine that, so that goes up to over the 600k mark. I think it also depends on the last 40 years. Depends on which measure you look at, and if you buy in London versus buying in Halifax or Dorset or places like that, because it's whether you're buying for capital appreciation or whether you're buying for an income rental return. I think the average yield depends on which way you look at it. It's probably about 10%, but it fluctuates depending on, as I said, where the location of the property is. One thing that property does give you that you don't really get out is the ability to, it might take, if you plan it might take you 2 years or 3 years or 5 years, depending on what type of rate you have and what you're tied into, but you can pull money out. And on top of that, you can pull the money out that you invested. And then even after that, you're looking at profit. So property, I'd be interested to see what you come up with, but I'm more than happy to give my view on property.
No. We want as many opinions as possible. It's an open forum. I'm not saying, I'm here to just give out facts and numbers that are there and let people make their own decision. I'm gonna destroy every asset class here. I'm never about just giving the pros. You got to give out the pros and the cons. And I never thought in my wildest days I would ever say cash is actually good. But in some cases, depending on your individual circumstance, it might be. Now, property.
Sure, it depends on what time horizon you're looking at. It all depends on time horizon.
Yeah, 100%. But in my opinion, as a young person that's 20 to 25 to 30, you got to really pay attention to where you're going to make the most from your money in the time period that you can take bigger risks. But I will say, just because I've got friends that are doing crazy things in property, if you know what you're doing in property is better than stocks. If you know what you're doing. But the amount of people that don't know what they're doing versus the amount of people that know what they're doing and the amount of time, energy, and stress it takes being in the property game, pretty much all my guys that I know are in property making big money a ball. Just stress. That's all they tell me is it is different levels of stress once you get over that 2 million, 3 million mark in property. It's a different...
absolutely. You become what's called a portfolio landlord, and then it's difficult to acquire lending. You pay higher premium rates. You're considered a bit bigger risk. But then that's when it comes back down to banking with people like Harlesden Bank, and who they are able to circumnavigate all of that stuff that you typically get with going through brokers. But that's a separate issue. But you're right. Anything over a certain amount of certain numbers, I think once you get to double digits, then you become what's called a portfolio landlord, and they start to hit you with additional fees. Then it's less profitable. But that's only recently happened in the last, say, 2 years, 3 years.
Mm-hmm. So let's go on to the next one. So the next one is something called a REIT. Now, this is something that, for some unknown reason, is never mentioned in school, ever in business studies. I've looked through countless business studies books and I hardly ever see this mentioned. And a lot of people I know in property don't know these exist, and I find it quite strange, especially considering the return that you can get on a REIT. A REIT, in my opinion, isn't something that you would invest in as a younger person, unless you're going to invest in a REIT from when you're like 5 years old till you're 25 years old and you've inherited 100 grand. Then, yeah, then it's crazy. Now, what is a REIT? A REIT is basically a stock that what they do is they invest in property and they own a portfolio of properties, and the rental income and the profit they make becomes the dividend. So the average yield on property when people are renting it, you know what? Let's just see what Google says. Go to Google Ninja and just type in average rental yield UK. Siri, why are you listening to my conversations?
She's always listening, bro. You know what I'm saying?
Always listening.
She's always listening, bro.
The average rental yield is 3.63%. So what does that mean? That means the value of the house, the average return you're getting back is 3.63%. Yeah? And that's per year, not per month. That's the bit that people always get twisted. Again, it's not really educated on. So let's do some maths here, Ninja. So let's go to a calculator.
Yes, sir.
And this is going off averages. We know these averages might be varied, but I very rarely hear of properties having higher than 5% rental yield. Very, 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 very rare. So what we want to do is let's also see what the average house price is in the UK.
I'm going to take a wild guess and say that the average price is 500k.
Nah, no way. That's in London. It's like 300k.
Oh, okay. In the UK, I stand corrected. My bad.
Yeah. You Londoners are living in a different planet.
It's just a different world.
Okay, so 285 grand. So let's work out what what was it? Let's call it 4% to be generous. So 4% of 285,000. You should just be able to type that in Google. What's 4% of 285,000? There we go. That is your average person's rental yield that they're getting for the year. So now do that 11,400 and divide that by 12. That'll show you what it is monthly. £950 a month. That is not bad. That is a great passive income if you can get yourself into that position. But remember, that 950, you've still got to pay the mortgage for most people, because most people don't own the property outright. And the mortgage, yeah. So, yeah, just consider that. So now let's go back to the REITs. So if I've explained my version of how I explain what a REIT is, but let's see what Google says. Just to show, again, all this information is out there and accessible to people. So what is a REIT? There you go. A real estate investment trust. A real estate investment trust is a company that owns and in most cases operates income-producing real estate. REITs own many types of commercial real estate, including office and apartment buildings, warehouses, hospitals, shopping centers, hotels, commercial forests, so on and so forth. Now, my personal favorite REIT is a REIT called Crown Castle. Now, why are they my favorite REIT? Because they own something that is essential. They invest in cellular towers. Now, is there going to be an increase in the use of cellular towers over the next 10 years? Yes.
Yeah.
Is it an ever-growing space? Yes. Maybe Starlink might affect them, but then they can just pivot and start owning satellites as well. So let's go to what REIT yields. Just type REIT yields on Google. Yeah. Cool. Best REITs for reliable income.
Average as well. We should put average because we put it average on the house.
Okay, yeah. So Dom says let's type in REIT average yields. $4.48. It ranges from 4.48 to 10.8%. Now, this is doing the same thing as property. You are getting the exact same exposure that you were getting from the rental income with a REIT. However, the difference is you can liquidate and get in and out every month, every week, every day, but you don't then actually own the asset. That's the difference. You don't actually then have a roof over your head, but the gains that you make are crazy. Now, why am I going to say the gains that you make are crazy? Because we're going to go and look on TradingView at the kind of gains some of these REITs can make over a 20-year period, plus the rental yield. So let's have a look. I should have my REITs list. Here we go. And again, this is crazy game that I'm giving you here. You get to see my REITs list. Do your own research on these. So let's go Crown Castle, because that's my B. That's my bay. And you know how we do. We go on to the monthly candles. So we said it was all good, but it's also all bad. Again, we got to be honest with ourselves. Look, yeah, if you invested in this REIT in December 2021, you are now down 48%. So you are getting hurt.
In comparison to property, where if you had a tenant the whole time, you would not have that risk.
You don't have that problem. You're not going to see your rental yields go down by 48%. But then when we take a zoom out, and we do over the last 20 years, let me just turn all these off. There we go. So obviously you got clarted in 2008. But let's go from 2003. June 2000. Oh, we're in July now. July 2003. Oh, wait. July 2003 to now, even though it's down 48%, you would have been up 1,382%. Now, I've not seen many properties go up 1,382%. Know what I mean? So if your rental yield, let's say you had £1,000 in Crown Castle, Ninja or somebody, can someone Google the yield on Crown Castle, please? I think it's 6%. I'm not too sure. It might even be.
Annual yield for Crown Castle.
Yeah.
5.37% in 2023.
Okay, so let's call it an average of 5%, or let's call it even 4%. Yeah. So that would have been of 100,000 that you put in, 4% of that, little $4,000. Yeah. You left that same 100 grand in. You didn't put anything extra in. You then got your 1,386% gain. So that 100,000 has gone up by 1,000. You're good at this side of the math, Ninja. So it's 100 grand. That's gone up 13x, 12x. 1.2 mil.
Yeah, that's 1.2 mil.
So over 20 years, your 100 grand investment, without putting anything else in, has now become 1.2 million. But let's talk about the compound effect. Let's talk about if you were reinvesting those gains, or you were treating it like a house. So you're treating it like a house, and you just putting in the mortgage in, little 400, 500 pound every single month, and then you're getting your yield back as well. Then you're in a total different stratosphere. And this is just Crown Castle. There's other ones like Realty Income Corp. You can see, again, since 2003, where are we? And this is considering the big drop in the big drop in 2008. And we're not even going to go to the all-time high. 209% on Realty Income Corp. So that one's not that great. Stag Industrial is a good one. We want Prologis. So Prologis, they do data centers. I don't know if data centers are going to be important over the next couple of years with AI. I don't know. Somebody tell me. Might be. Let's go again. 2003. March, June, July. So up to where we are now. 275% over 2 years, over 20 years. 488% at the high over the 20 years, plus your dividend income. So that is REITs. Any questions for me on REITs? So pros and cons we've gone over. They can drop in value and you can get merked. But over the long run, the gains that you make
tend to be bigger.
Just tend to be bigger than what you're making from property. And then that means that your rental yields are also bigger. And it just comes with way less stress. Way less stress. No tenants, no maintenance fees, none of that. Just simple. Okay. So that is REITs. And then stocks. So Ninja, if we go to the Instagram.
Sorry.
Because on stocks, most people are aiming for the 10%. That's what they're aiming for, because the S&P apparently averages 10% per year. However, this is what happens in reality. It doesn't do 10% a year. That's the reality. The reality is it does more than that. And the reality is it actually overperforms or underperforms that. Keep going. Is it still there? Not that one. Oh, yeah, you can see here. Here's all the fluctuations. But let's keep going. Next image. I think it's one more. So this is the amount of interest someone's paying over time, over 4 years on a property. So you can see on that one. But yeah, look into that. Next image. Oh, you're not there. Oh, there it is. There it is. There it is. The green and red one. Green and red one. Left. One more. One more left. Yeah, there we go. So these are the actual total returns for the S&P 500 year on year. So you can see if you were investing in stocks all last year, you're down 18%. You're in pain. That's just the S&P 500. Some people can't afford and haven't got the stomach to see their portfolio go down 18%. Of course, Trading 212 just did that. Ascente. Especially if it's their livelihood, especially if it's all that they've got. This is why, as a younger person, you're probably in a position to stomach it a little bit more. Because if it's your first time investing in 2020, 2021, like it was for most people, and then you get clarted and you go down 18%, and some of your stocks like Netflix or whatever are down 70, 80%, that's it. You're out. Forget it. I'm doing property for the rest of my life. I'm doing gold for the rest of my life. That's what you're going to do. So this 10% figure, number one, as you can see, the S&P 500 does more than 10% quite a lot. Number two, individual stocks do more than 10% quite a lot, like Apple, like Nvidia, like Google, like Tesla, even Meta. Non-technology stocks. I'm not going to comment on them because I don't know about them too much. Maybe Berkshire Hathaway does well, but Berkshire Hathaway is basically a technology stock. Berkshire Hathaway is technically an index at this point in time, but more on that another time. So pros and cons there. You can see the cons quite easily. The pros, easy to get into, easy to get out of, loads of information, doesn't require much thinking. It's just put the money in, forget about it. That's it. So let's now go to the compound calculator.
Let's go.
Oh, the compound one. Yep, there we go. Initial investment of £1,000, average 10% over 20 years. Boom. Calculate. Boom. You've just made £7,000. Yeah? From your initial balance of £1,000. But let's say you add in that £300, £400 a month. $350. I like it. Boom. There we go. Over 20 years, I think you'll find you got the equivalent of basically a house. It's pretty easy to liquidate as well. And guess what? If you do this through an ISA, a tax investment ISA, that's all tax-free. But again, this stuff isn't educated on that much. So let's go to the last one. The one everyone's here for. Crypto. So let's talk about this thing called Bitcoin. Well, actually, Emily, now's your chance. I know you're dying to talk about Bitcoin if you're there. Emily, you still there?
It's the bit blunts time. It's the bit blunts time.
Oh, I don't think she's there. If you drop her a message, Ninja. In the meantime,
All right, cool.
Does anyone know the return on investment of Bitcoin over the last 10 years? Someone Google it then. Because again, this is all obtainable evidence, all obtainable information. 68% per year. Boy, that's wild. Wow. So 68% per year. Now that's averaging out with the bad years. Now, in 1 year, what's Bitcoin capable of? Ninja, what's the most you've seen Bitcoin do in 1 year?
Sorry, just very quickly. I've just got off the phone to Bitblon. She said she lost connection. She's going to try jump back in about 10 minutes. The most I've seen Bitcoin do in a year, I've seen it do like 3-4x.
Yep, 300, 400%.
But then the year after, it might do like.
But what's the most
-60%.
you've seen it lose in a year? I've seen 82%.
Yeah, something along that drawdown, 80%-ish drawdown.
Yep. Can most people stomach an 80% drawdown?
No.
No.
Nope.
That is devastating.
Here's the ultimate bad thing
And
about.
what about also depends if you don't invest in a smart way and you don't invest the money that's more than is disposable, then if you need cash quickly and your investment is down by 80%,
can't take that
how
out.
much have you got available to take out?
Nothing.
So we really need to plan what you invest and where, and like if you need to touch that money or if you don't need to, just so you can actually take it out when it's the best possible time instead of having to take it out when it's down and you're desperate.
Yep.
Because that
ruin you. Now, here's where it gets worse. And this is why I would say Bitcoin is probably one of the worst. Oh, average annual return of 1,576%. Total return of 18,000%. Okay. That's wildly different, Alex.
No one is going to do
so
just come out of nowhere and said they do not like Funky D, so I'm going to send it to.
Oh, Hamdi Hassan's listening to the rhythms at the same time as listening to this. Fair enough. First, no comment. So in regards to Bitcoin, here's my reason why I think it's a terrible investment. Number one, altcoins tend to do more than Bitcoin.
it's unpredictable.
Number two, Bitcoin, most of the time, when people think they're buying Bitcoin, they're not buying Bitcoin. They're getting scammed somewhere along the line by some exchange, by some whatever, by some fraudster going, oh yeah, invest with me and I'll buy some Bitcoin for you.
You can't buy a cash.
So the level, the intelligence and independent research level for actually investing in Bitcoin is very high. I don't think it's as easily accessible as just putting your money in a bank account. I don't think it's as easily accessible as investing in stocks. I've yet to see someone running a scam where they're telling you you're investing. It probably does exist, but they're not as popular as it is with crypto, where someone's like, yeah, give me your money, I'm going to invest it in this REIT. Doesn't happen. Not that I've seen. Very rare do you see, yeah, give me your money and I'm investing it in gold for you. Doesn't really happen. Yeah, give me your money, I'm investing it in Apple stock for you. Doesn't really happen.
Happens more often.
It's happening more often now, but in crypto, boy, we see that all the time. So that is where I would say the downside is on Bitcoin.
And you need to educate yourself a lot about different how you trace transactions, the different ways of buying the crypto.
Now, my personal strategy, and what we cover in all of our lessons, is a very simple strategy for Bitcoin. When it's above the 200-day moving average, you get in. When it's below the 200-day moving average, you get out.
You get out.
It's as simple as that. That method for stocks and crypto, it's as simple as that. But does the average person have the time, the energy, the focus, the discipline, the stomach to do that? No.
But I feel like you forgot to say when it just breaks the moving average, not like when it's
gone
crazy above or crazy below.
And people don't watch, people just aren't watching their assets on a weekly. Even some of our students, I know for a fact, you're not looking at your portfolio and going, okay, let me see where it is above the moving average on a weekly basis. I know, because it requires a discipline that most people don't have. So the secret thing is about most REITs you can get on most platforms. You can get them on Trading 212. You can get them on even Revolut. I had Crown Castle on Revolut before I realized it was quite dumb for me to get Crown Castle right now. So is Bit Blonde back? Yep, Bit Blonde is back, but now she's got no audio. Damn. Right, what was I saying? I was talking about REITs where you can buy them. No, I want to talk about commodities.
Buy REITs on the tax-free ISA.
Yeah.
You can.
Yeah, you can buy REITs on the tax-free ISA. So think about that. Up to 20 grand a year that you can be putting into a REIT every year. Mad. But anyway, do your own maths, do your own research. Commodities. So if you go back to that Instagram post, please, Ninja.
Yeah.
There's a post that literally has it all laid out in a chart for us. There we go. This is the return on commodities versus cash versus bonds versus stocks over the last 5 years, over the last 10 years, over the last 15 years, over the last 25 years, and over the last 50 years. And we already said what property is over the last 50 years. So we can see, without a shadow of a doubt, stocks have been the best investment over the last 50 to 5 years. We can see, without a shadow of a doubt, bonds have actually been better than cash, and bonds have actually been better than commodities. I hate to tell you, but unfortunately, investing in gold and in commodities, you would have actually been better off keeping your money in cash over the long term. And again, this is because the majority of people that are investing in gold long term, they're doing it based off a hearsay, and they are not. The amount of people that I know that stack up gold and look at gold all the time that are not looking at the 5-year, 10-year, or the monthly time frame of gold is crazy. Now that's in the UK. And again, we've already been through this before, as Ninja showed. When you zoom out on gold in different currencies, it's a total different ballgame. And again, let's look at this here. Let me just share my screen. So gold was the key sentence is was doing well. Was. Again, we're going to compare it. Let's have a look, see. So we're going to go from 2003 in July. Oh, you back? Are you back?
Back.
Bit blonde, are you back?
It's a bit blonde here.
Sorry, guys. Internet is really bad. That's why I was like, I don't know what I'm gonna do.
Oh, it's fine. It's fine. We got you back. So we're just wrapping up on gold and showing that over 20 years, it would have been, your return on investment would have been 385%, which in comparison to Bitcoin, it kind of does that in 1 year.
In comparison to other things, it's quite decent.
But in comparison to other things, in comparison to cash, it's great. In comparison to a bond, it's pretty great. But unfortunately, most people missed that entire bull run up until 2012. Most people got in maximum around here, 2015 to now, to that high, which is around 80% gains in about 9 years. It's not the greatest. So, Emily, I was asking people about Bitcoin and why they believe, or in their opinion, Bitcoin is a great investment. So I wanted to give you a chance to talk about your true love.
Thank you. Yeah, thank you for having me on. It's pretty much bad, the Wi-Fi here, but I'm gonna try to my best. So yeah, I totally agree with you. I think gold and property, it's not like they're bad investments. It's just not doing well. So Yeah, with crypto is different, but you know, the majority of people still a little bit scared of it. But you cannot compare the gains with cryptocurrency and normal real estate or whatever. And I think it also goes to the direction of society mindset. We're living in a different time now. Like I just use that a lot as an example. Like nothing that is physical is worth it for me, but it's not like that we don't need to have anything physical. It's just like our crypto bubble or whatever, you know, people in Web3, we don't really see value anymore in physical things. So that it's also a different living time, I would say. So that's why we see so much value in whatever is digital. And you know, it's just how we change the ways of payments and things. And I think whatever was on the past is not going to work for the future, and we have to adapt ours.
Yeah, I would say for me, the one thing about Bitcoin in comparison to everything else we've covered today is the speed of transfer of the asset. Owning gold and transferring £1 million of gold to somebody, good luck. Good luck. The physical weight of that, good luck to you doing that. The hassle of transferring £1 million worth of property to someone, nightmare. The hassle of trying to transfer £1 million of stocks to someone, nightmare. Even trying to move £1 million cash, nightmare, from one bank account to another. Whereas with Bitcoin, that can be done in what, 8 minutes? If that?
Yeah, it's absolutely different. And also think like the way people live today is different. Like people like to be free and travel and, you know, earn passive income. So if you have something that, you know, takes a lot of your effort and time to do, you know, it's just a headache. So like the millennials don't want to deal with that. That's why cryptocurrency is so valuable also. But yeah, gold hasn't done anything. If you really look into it, I don't even know why we use gold as a head of inflation anymore, because it's not moving. Look into the charts. It's literally not moving. And it's fake, actually. You know, it's not even the gold. It's just...
Facts. And you know what I'd also say is one of the plus sides of property is that you can get a loan against your property. You can remortgage. However, I think a lot of mainstream society don't realize that you can get a loan against your Bitcoin. I think once that becomes general knowledge, and once this whole, oh yeah, Bitcoin's used for fraudulent transactions. Like I was in the gym the other day, went for some lunch, and I saw two old guys talking about Bitcoin. And they said the classic thing, but isn't it used by North Korea for illegal transactions? Isn't it used by drug lords? And I said, potentially, yeah, I'm not going to disagree with you, but isn't cash? And they went, yeah, and then they went, that's not the point. I was like, so how can you compare one thing to another, but not judge them by the same standards? I said to them, how much money laundering and ransoms are done for cash and have been done for cash over the last...
And
offshore banking. How much is like? And they were like, yeah, well, that's not the point. I was like, well, it is, but just nobody wants to accept or look at how bad cash actually is. If you are a criminal, Bitcoin isn't that great for you because it's more likely to be tracked than physical cash. And then in terms, so that's the downside. So the downsides of crypto, I said, Emily, is that unfortunately a lot of people will struggle to invest in it for 10 years plus or even 5 years because the drawdowns are so dramatic, because the drawdowns are like 60, 70, 80%. I don't think a lot of people can stomach it. Would you agree?
Yeah, you mean that we are on a down cycle?
Yeah. I think from what I've seen, when it comes to normal people, the masses, whenever Bitcoin's in like a bear trend, people are just sell everything. And it's like altcoins. Altcoins are like shit companies going bust. But when shit companies go bust on the stock market, nobody cares as much. But when a crypto goes bust, it's all the rage. So I think we don't judge them by the same standards. So yeah, that's my take on that. So yeah, just wrapping up. I was talking about the highest gains I've seen on Bitcoin and crypto. I think the highest gain I've ever seen on a crypto was 32x. And I think the highest I've seen on Bitcoin is 400%. I think I saw.
What period of time?
Over a year, which is insane. And I think people need to really understand, when you're younger, you can invest into more riskier things. And my personal strategy, I'm just going to tell you what my strategy is. A portion of my portfolio is crypto. A portion of my portfolio is stocks. Once they get to a certain level, then I'm going to put them into Reits. Then once they get to a certain level, then I'm going to buy physical property. Once my physical properties get to a certain level, then I'll buy commodities. But until then, I'm just not doing it. I personally cannot justify, because I don't have the time, the energy, the skill set, or the knowledge, or the interest to learn about property. I'm not going to go and learn about that if I can get more gains in stocks, in crypto, for less effort. It's more reading than anything else in those two spaces. And for me, make the gains there and then buy the property outright, so I'm not paying crazy interest or bothering with these interest yields and whatever. So that's me personally. That's what I would say. I'd say you need to have all of those assets that we mentioned today, but you got to figure out what's your strategy for getting in and out of them. What's your risk tolerance, and how much can you afford to lose? Because, like we said, each one of them has got a downside. Emily, what would you say is the downside of crypto or Bitcoin?
I don't really think we are like going any way lower than we are at the moment until the next halving, I would say.
Okay.
I think we're just gonna kind of hold around 40, 60. But remember, when the miners change the network, we could have a very, very strong drop again. So apart from that, I think the bear market could be done actually from now. I don't really see, us going lower than this point, honestly. But everything can happen.
I mean, I think when Bitcoin was around 15K, I remember, I think I did a show with you and it was like, this might have been the bottom. Everyone might have missed it, but who knows? We'll see. But yeah, thank you ever so much, everyone, for tuning in to today's show. Emily, thank you ever so much.
Thank you so much.
You want to plug your channel? Do you want to tell everyone where they can follow you?
Oh yeah, please follow me. Pretty much everywhere. The Bit Blonde. It's pretty easy. I can leave here on the comment section. Thank you for having me, and I hope to see you guys in person when I'm back to UK.
Definitely. No worries. See you later. See you later, everyone.
Thanks, guys.
Oh, actually,
Thank
I've
you,
not done any
Big
questions. I've not done any questions. I've got to do some questions.
No.
Some question.
Go on. So, let's quickly go around and ask anyone.
Thank you.
No worries. Thank you. Let me just quickly ask questions. Did anyone have any questions? That would be the better way of doing it.
Yeah, I got one.
Yeah, go on.
I just seen recently like the recession's trending on YouTube, and as a man of the world, I was wondering what your thoughts were on that.
Well, of course it's trending on YouTube now. Of
Because I
course,
remember
look, we've been in this recession for at least a year and a half. And they changed the rules and the definition of what a recession is. What will happen is they'll announce a recession, And that's when the markets will go up, just to confuse people even more. But what it'll do, the markets will start moving up, but the masses won't invest, and they'll get even more scared and more stupid with their money because of the word recession. Now, what makes me so confident in that? There's a guy where his surname begins with B. Man like Biden. And if you go and do your research when it comes to political years, when it comes to people getting their votes to go stay in power, the market tends to go up. Also, the interest rate in America can't really keep going up much more, because eventually they're going to start going back the other way. They're going to start pulling it back. And when they pull it back, tech stocks are going to do better.
Okay.
And the market's going to go up. So all these things coincide. And based on history suggests that July and August are bad months for tech. And then September, October, November, December are great months for the market. And that's going to be going into the new presidential year. So in my opinion, September, October, November, December are going to be great times. But that's when they're going to announce a recession. But the stocks are just going to be going. Psh.
Okay.
Or maybe not quite then. Maybe they'll wait until Biden's got another term or whatever challenger is the new president and then announce a recession.
Okay.
But I think the markets are going to get propped up and held up as much as they can. But it'd be interesting to see this quarter's earnings for a lot of companies, because a lot of companies should have performed whack. But we'll see.
Okay. Safe.
Go on, Dubem.
I was asking, what do you think? Because I've got an investment like Meta, and I've seen that pop up. Like, what's your prediction? Do you reckon that's going to keep going up, or?
Oh yeah. I base everything off stats, data, and history. You show me, over a 10-year period when Marky Mark has missed. When has he missed? When has the Zook missed?
No.
If there's one thing that guy can do, it's learn from his mistakes and learn from criticism. Nobody recognizes that about him. Everyone said buying Instagram was a mistake. Gave him bare criticism. Need to change this, need to change that, need to change this. Changed it. Even when it came to simple things like Facebook, when he did the updates and changed the news feed and all of that stuff, everyone was kicking off, saying how whack it was. But yet the user base went from 1 billion to 2 billion. So Marky Mark don't miss,
I got
final thing on Marky Mark, I don't think people are realizing how much these Oculus headsets are going to go off. Because the average person around the world, we're not talking about America. We're talking about Africa. Where like business-wise, would you rather sell an item for £500 to a population of 1 billion, a population of 300 million in Indonesia, a population of 300 million in Nigeria, or for £500, or sell a product for £2,500 to a population of 60 million in the UK and 250 million in America?
Give me the motherland.
Yeah, where the average person doesn't have £2,500 in their account, let alone to buy a fucking headset. Whereas I think Marky Mark's onto something here, because what's going to happen is, just like what happened with the AirPods, how many people do we know, or have we seen that have got an alternative to AirPods?
Mark, I think to add to that as well, when it comes to the user bases, it's in those type of countries, I think what they're thinking about is how much can we earn from their data? It's not necessarily about the user actually paying a lot of money, because they have ways of monetizing their users.
Yeah. Whereas in the UK, like, I think Marky Mark is, you have to remember, the Oculus headset sold more units than the Xbox One. That's crazy. But no one's talking about it. Remember, Google tried to get into the gaming space with Google Stadia. It flopped. But no one's talked about Google flopping Stadia. No, there is no press. No, nothing.
It's not their lane.
It's not their lane. But Zuck, it is his lane. Do you know why it's his lane? He had one of the biggest games of all time in all of history on his platform. It was a game called Farmville. It's one of the best-selling games of all time. That game was doing bits on Facebook.
Wasn't Candy Crush on there as well?
Yep. Yep, initially. Marky Mark don't miss, you know. He doesn't miss.
He does sometimes.
Yeah, but what I said is he misses, but he recovers. His recovery rate is crazy. Like, there's a saying in life, how's it go? I sound like that guy that goes blah, 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 blah.
How far you fall is how you get up.
Oh yeah, it doesn't matter how hard you fall, it's about how quickly you can get back up. That's it. And Mark is rapid at getting back up. Rapid. Like, he can take hits differently. And remember, in comparison to everyone, he's got ops, bro. Different ops. But he still gets back up. His own country's Congress doesn't like him.
Mad.
And he's still doing these bits.
So this little thread scandal's not gonna hurt him.
Nah, well, come on, it's Marky Mark, bro. You think Threads is gonna hurt him, bro? That's what they said about Snapchat to when Instagram dropped Reels. No, not even Reels. Is when Instagram dropped the bloody
stories.
The stories. Now look at Instagram stories.
Yeah, that.
Bigger than Snapchat.
Elon's sending for him though.
About Reels. Now look at Instagram Reels.
Yeah. But I mean, Elon's sending for him, so you know.
Yo, he can send all he wants.
The cage fight.
Marky Mark don't miss, bro.
Elon's got double the money, but social media is not Elon's lane.
Yo, Elon's got double the money, but Marky Mark has got 100 times the data. And 100 times the user base. There's 2 billion people on Facebook, bro.
Yeah.
This guy's different. Different. Because remember, this is what people forget as well. If Facebook disappears, Amazon sales go down. Apple sales go down. Because remember, Apple, where do they make their money? They make 30% or is it 20% of any purchases made through apps on their devices. So who do you think is one of their biggest ways of making money? People buying things on Instagram or seeing an ad on Instagram and buying it on Amazon.
Oh yeah, Instagram. Yeah, I forgot about Instagram. So
that Apple are making racks from Facebook.
Also, Elon definitely knew the threats was coming up.
Yeah, he knew. See you later, Eunice. So yeah, man.
Bye.
Don't miss. Did you have a question before you go in?
I think the question is about the FYI.
Oh.
She's gone.
Oh, yeah. We've got to cover that next week. Definitely got to cover that next week. I'm going to start putting in the research today. Any questions? Anyone else? Alex? Or Samuel? Otherwise, I'm going to bounce. Got to eat my chips. Got cold. Calm. Any questions? Nope. All right. Cool. Peace, people. See you later.
Cheers.
Share this episode, please, people. Share it.